Hello everyone, George DeSantis here with the look at the market for the week ending December 30th, 2016. As we always do, we read the disclaimer. Trading and investing has large potential rewards and large potential risks. This video presentation is designed for educational purposes only and is not a solicitation or advice to buy or sell any securities or other tradable instruments. You must be aware of the risks and be willing to accept them in order to invest in the markets. So consult a licensed professional investment advisor for investment advice. Let's begin by taking a look at the monthly chart as we always do, and that is of the S&P 500. So here's a monthly chart of the S&P 500. And we look at this simply because it's the longer term trend of the market, S&P 500 being the 500 stocks, etc. And what we have is an uptrend that started way back here, back in February really, and has continued since with a certain pullback here or regression to the mean. At the current time, we have a bullish bar. The Kalman filter is above the instantaneous trend line, and the closing price for the month was higher than the opening price. So it's a bullish bar. The parabolic is still below the most recent bar. So we have no indication here to reverse the direction of this uptrend. In the middle of the chart, we can see that MACD histogram is trending up, and the fast average is above the slow average. And at the bottom of the chart, Elder Force Index, the 13 period or 13 month in this case, broke above this trend line and continues to trend up. So nothing really changed much on this monthly chart. It is that long-term chart. Now we wait for the month of January to show what we can discover there. But let's take a look at a weekly chart. Here's the weekly chart of the S&P 500 we usually looked at. Couple of things to notice here. First of all, the Kalman filter is still above the instantaneous trend line. And that indicates to us that the trend on the weekly chart is still up according to this relationship of the Kalman filter and the instantaneous trend line. However, as we've been pointing out for the past 2 weeks, previous to last week, we had dojis here, these candlestick, small-bodied candlesticks, uncertainty, hesitation for any further move up. Now last week we have a bearish engulfing candle, where the red body of this candle totally engulfs this small green body of the previous candle. So that's one of the bearish signs here, that this market is likely to continue to pull back or retrace closer to the instantaneous trend line. So we do have the lookings of an uptrend. We still have an uptrend. No signal from the parabolic to reverse that, but we have every indication that this market is going to retrace further, perhaps back to the first level of support here, somewhere around 2200, 2210, somewhere around there. Okay. Now, the other thing to notice here, which we took a note of last week and for the past couple of weeks, is that we've had a bearish divergence of MACD, moving average convergence divergence, a bearish divergence of MACD from price. And for those who are new or not quite familiar with the bearish and bullish divergences, as the market made a high here, MACD made this high, MACD histogram. Then the market pulled back, the S&P pulled back to make this low. MACD made this low. What my friend Alex would say is that this broke the backs of the bulls, so that when this market made a higher high than this one, and we drew this line here, MACD could not make a higher high here than this one. So we have this bearish divergence, which now, last week, we had a smaller histogram print here. So it looks as though we're going to retrace to somewhere close to 2200, and we'll see how that plays out. In the middle of the chart, percent R is still above 80%, and so that sort of supports the scenario that we're still in a bull market, long-term and intermediate term, monthly and weekly chart, but we are in the midst of a pullback. Now, RSI 12 similarly bounced off of the 40% line and is pulling back to 60. And also at the bottom of the chart, we could see that bearish divergence, and MACD is still above zero. So the bulls are still in charge to some extent, but there's some weakness here, and a pullback is in progress. Let's take a look at the daily chart. So here's a daily chart of the S&P 500, and you will recall that last week I talked about the squeeze of the Bollinger Bands, and that the squeeze indicates that you want to get somewhat of a dramatic move, either up or down. We saw we had an up move here, we had a down move here after this squeeze, and after this squeeze we had an up move. In this case, we seem to be getting that down move. How far down? Well, I put the Fibonacci retracement levels here. The 38.2 level retracement level, we hit that, we surpassed that on the downside. We're just touching the 50% retracement level, and the next level is 61.8 on the Fibonacci's. So it just so happens that you will notice that if 61.8 level is just above 220. So in this region here, between 2200, well, call it 2214 and 2220, we are likely to get this retracement to come back here, as I was saying on the weekly chart. So look for that retracement to come back here and perhaps find support at somewhere around 2214 or so. That's what we'll be looking for. So this pullback is not over, because we have a bearish engulfing candle, and we had a bearish engulfing candle here during last week. So these two bearish engulfing candles tell us that the momentum on this downside is a little strong. It's quite strong. In fact, if you look at this indicator, Jerry Appel's sum of the rate of change indicator, we can see that it crossed below the 4% line for the first time since back here, early December. So we crossed below the 4% line. So if we're using this for buy signal, we now have a sell signal on this, okay, buy or sell. MACD is trending down below the zero line on the daily chart, so the bears have taken control, at least for a while, and at the bottom of the chart, percent R crossed below 80 and is headed toward 50%, that magenta line. So the daily chart is obviously looking much weaker. It's telling us that we could expect further decline, most likely to the support level of around 2214, which comes in just at about the same level of the 61.8 Fibonacci retracement. That's the bottom line. Let's look at something else. Here's a weekly chart of the Nasdaq Composite. So the first thing to notice here is that we still have an uptrend because the Kalman filter remains above the instantaneous trend line. For those who are new, the instantaneous trend line is the blue line. The Kalman filter is really a 4-period simple moving average. In this case, it would be a 4-day simple moving average. So we still have an uptrend going on here. However, on Nasdaq Composite, the weekly chart, notice this bearish engulfing candle. The body of this candle, this red body, totally engulfs this small bodied green candle here. So consistent with what we saw earlier with the S&P 500, we are going to have a retracement back to closer to the instantaneous trend line. However, it doesn't mean that this trend is over. We're going through a retracement, in my opinion. The parabolic is still below the most recent bar. So there's no indication from this yet that we should change to a downtrend on the on the uh, Nasdaq Composite. Having a little trouble with my voice this weekend. In the middle of the chart, RSI 12 is still close to the 60% line. It crossed below it again. However, it's way above the 50% line. So it looks as though we're going to get a retracement, as I said, on the S&P, showing up on the Nasdaq as well, and bringing this RSI 12 closer to 50%. Hopefully, we'll get a bounce off of that again like we did here. And the other important thing to notice, though, which is probably even more significant, is this bearish divergence of MACD histogram from the Nasdaq Composite price. Again, as Nasdaq made this high, MACD made a new high. Nasdaq pulled back. The bulls were the back of the bulls were broken by the bears pulling them below the zero line. And when the Nasdaq made an even higher high, MACD could only make this high, which was much lower than this high. So we have a bearish divergence on MACD, which is being played out in this retracement, just as we saw on the S&P. All right, let me take a look at something else. And here is the stockcharts.com chart of the S&P, the weekly chart, showing us the impulse indicators with green, blue, and red bars. Right now we have a blue bar at the extreme right of the chart, and it was on declining volume here. It was on low volume because we were going into the holidays. On the other hand, it's a blue bar. What it does is it says, look, we're allowed to either sell or buy the market, buy the S&P. If you were looking at an individual stock on this chart, it would refer to the individual stock. In this case, it's the S&P. So we're either allowed to go long or short. However, since the trend is still up, I don't think we should be shorting this market here. So that's what the weekly chart shows us. Let's take a look at what the daily chart shows. Now on the daily chart, we have 3 red bars, okay, and the last bar is red, and we can see the low volume here in the latter part of the week. We can also see that we had MACD trending down. We had a bit of a bearish divergence here, we could see that, and now MACD is below the zero line. So as we saw with the other charts, the daily chart is pretty bearish, whereas the weekly chart is still in an uptrend. This is in an uptrend too. So we'll wait and see how this develops. But as I mentioned earlier, it looks as though we're in the process, from this chart as well, process of a retracement. And we're probably going to retrace somewhere back to this level of 2214 or so. If we break below that, we have more pain ahead. I'm going to rest my voice. Have a nice weekend and a very happy, prosperous new year to everyone. Okay? A healthy and prosperous one. Thank you for listening.